Okay, we're going to move on to our panel now. Thank you, everybody. And my name is Lisa Vioni. I'm the CEO of Hedge Connection, which is a web-based marketing platform for hedge funds and other financial institutions, as well as we have a deal room. I'm going to moderate this panel. We've got a wonderful group up here. I'm going to go through who is on the panel, and then we're going to jump right in and try to take this topic from, big picture and bring it in micro, and then open it up for questions from the audience. So my panelists are not in the order of where they're sitting, but in the order of my list here. We have Ron Quaranta, the founder and chair of the Wall Street Blockchain Alliance, editor of the recently published book, Blockchain in Financial Markets and Beyond, Challenges and Applications. Christina Dolan, internet pioneer, CEO of Inside Chains, co-founder and COO of InsureX Technologies, Fix Blockchain Working Group, to name a few. Christina has been speaking about the potential of cryptocurrency from central banks to blockchain for over 3 years. Jeff Bandman, he's the architect of Lab CFTC, founder of Bandman Advisors. Jeff, a former regulator, recently addressed the SEC Investor Advisory Committee during what has been an active regulatory environment for cryptocurrencies. Emmanuel Adu, he's the head of blockchain and cryptocurrency strategy at Credit Suisse. And Joshua Ashley Clayman, chair and founding member, Blockchain Plus Smart Contracts, Morrison & Forrester LLP, who is recognized as a top 12 blockchain and cryptocurrency law firm globally by Chambers and Partners. Now, before we open it up for the panel, I just have a quick question. How many people in the audience have opened up an account on either Gemini, Coinbase, or Binance? Okay, a lot of people over here and not so many over there. Okay, so we've got a group over here who understands what it means to actually buy a cryptocurrency. So we're going to address some of the issues around actually opening up an account, buying it, liquidity, valuation, and so on. So to move now to the panel. So panel, we've seen the cryptocurrency market it's obviously been very volatile, but in the recent day or two has been extremely volatile. Would anybody like to comment on some of the factors that led to this volatility and whether or not you see those issues, whether they're related to regulatory fears or issues in Asia, how that's going to affect the pricing of cryptocurrencies going forward in the next month or so? Christina?
Well, is my microphone working? I would actually say that, having come from traditional sort of financial markets where you had economic indicators that would, affect the market, especially like in fixed income or FX. But in this space, I think there's a lot more of an emotional aspect to it, and there's other variants that make the cryptocurrencies sort of oscillate or act a little oddly. And so, there's been some discussions about, obviously South Korea and a number of, regulatory comments. But they sort of come and go, and there are a lot of factors. I mean, one of the things that I think actually affects the price, which doesn't affect traditional markets, is a fork. For example, this summer you had a fork in Bitcoin, and then you had a fork in Ethereum, which I think in some way tempered the price. And so there are a lot of factors that go into that. And of course, as somebody had mentioned earlier, you do have the effect of interesting ICOs that come out, and then people sell some currencies to buy into these new, token offerings. So it could be a variety of different things.
Jeff, being a former regulator, right? This is one of the, I think, hot topics for everybody, or at least a fear that most of us have when it revolves around investing in cryptocurrencies, which is the SEC. Are they going to jump in? When are they going to jump in? Are they going to pull the rug out from underneath us after we just bought, some Bitcoin? Do you have any insight into what's actually going on in the heads of the SEC or the government?
Yeah, I think that it's helpful to look at this, to look at kind of regulation more broadly, and I'll come back to the SEC in a moment. But I sort of go through kind of a waterfall of looking at, who are the different regulators and what are they likely to do about it, in the U.S. Maybe we come back to the South Koreans, because I think that's been misunderstood. So first of all, just, is Bitcoin legal? Are these cryptocurrencies legal? Is somebody going to abolish those, make it illegal to trade those in the U.S.? I think we've passed that moment. To me, the watershed moment was when the U.S. Marshal Service auctioned off the Bitcoin from Silk Road. And Silk Road, as some of you may know, was sort of a dark web type marketplace where people used Bitcoins for illegal transactions of various kinds. But the Marshal Service sold off those Bitcoins in a public auction. And, when they seize a motorboat from a drug dealer, they sell off the motorboat. When they seize, illegal contraband or illegal narcotics, they don't auction off the narcotics. So, to me, kind of a watershed moment was when the government auctioned off the Silk Road blockchain, Bitcoin. It actually traded at a premium. And in fact, there's another auction by the U.S. Marshal Service that's coming up later this month. I think it's going to be the minimum block size is either 100 or 500 Bitcoin, but there's going to be another auction. So these are not the hallmarks of something that U.S. federal regulators are going to shut down and tell people in this country they can't own. It's a legal thing. And, so I think people can take a fair amount of comfort from that. And, regulators look at one another's definition and their actions. The CFTC, when we looked at, made the determination that Bitcoin was a commodity, we looked at what Treasury had said, how the IRS had defined it. Was it property or was it not property? We looked at what another part of Treasury called FinCEN, which looks at financial crimes, which has concerns about anti-money laundering, know your customer requirements. Those requirements are here to stay. Those are going to be very strictly enforced. Anybody who thinks that they can sort of transaction these things anonymously and not pay taxes on them, I think has another expectations coming. So it's a legal product in this country. There will be supervision of know your customer. You're going to have to pay taxes on your gains. Turning now to the question you asked about, what is the SEC likely to do? There are people who say the SEC doesn't understand it. I don't agree with people who make those criticism. The SEC, like the CFTC, formed a staff working group to start monitoring cryptocurrencies and blockchain. They actually started doing it 5 years ago. They started their group in 2013. So a lot of staff has been looking at it for a long time, and they've been studying it closely. I think they're being very careful about whether they are, how the token market for tokenized asset offerings or initial coin offerings is going to be treated. I'm sure the panel will have things to say about that. I think the SEC is being very careful with some of the applications for exchange-traded funds, which would potentially let retail investors transact in these through kind of an SEC framework. But, I think these are legal products, and I think they're here to stay. Great.
Okay. You brought up a word, token versus cryptocurrency. And, this is a new market for most of us and a new vocabulary. And I'm wondering if one of the panelists would like to differentiate between what a token is and what a cryptocurrency is, and then how all of this relates to the blockchain and a smart contract.
So that's a tall order, but I'm happy to talk about some of it. So when people talk about cryptocurrencies and then they say, well, which ones are cryptocurrencies and which ones are digital tokens? Well, they're all digital tokens. They're all digital tokens. We just call certain of them cryptocurrencies just because we're familiar with them and because they're often used, to transact business or as a store of value. So for example, Bitcoin and Ether, people sometimes call cryptocurrencies, but they're still digital tokens. And digital tokens, what they ultimately are, they're just a string of numbers on a digital distributed ledger. So it's not a coin per se. It's not something that you can hold in your hand right now, although some people did get original Bitcoins with serial numbers, right? But that idea that it's really a string of numbers, it's more like your credit card number. If you think of it that way, you can think about how sometimes, you get into the question of, are all of these securities, are all of them not? Or why is there this confusion? If you think about it, you could have a string of numbers, and you could say, okay, whoever has this string of numbers is going to get to vote, right, on this particular item. Or whoever has this string of numbers is going to receive a profits interest or something like that. You can make it look like a traditional security, a debt security, an equity security. But also, if you think about, some of the big box, large software companies, when you buy Microsoft Office, and let me just say this quickly. Nothing is legal advice and nothing is investment advice. And nothing I say is on behalf of my firm. It's just my personal views. But when you get, for example, Microsoft Office, and when you're loading it, right, it asks you for your key. It asks you for your license, and that's a string of letters or numbers. I haven't looked at it recently. So you can see also how a digital token might be a software license in certain circumstances. It could also just be a string of numbers in a larger data set. So
can I add to that? So the way I tend to think about them, like I'm going to add to your foundation there, is that maybe I should use my disclaimer as well. But, okay, it is. So I tend to think of a cryptocurrency as having a separate value to an underlying asset that it might be pegged to. You're right, they're all tokens, but I differentiate a crypto asset like Bitcoin. Let's say I've got, let's make it up. I've got a token called Emmanuel tokens. And Emmanuel tokens can be used to buy. They exist. They don't exist. It's my first experiment in Bitcoin. I downloaded the code. I changed the word, and it be called Emmanuel tokens. They don't exist. I promise you. But let's say Emmanuel tokens can be used to trade bread, right? Well, bread has a separate price to Emmanuel tokens, and that's where you get the cryptocurrency piece from it. When you've got something that's a token used to buy something else, goods and services, that has a totally different price to the underlying crypto, that's how I tend to differentiate. Having said that, I actually find, and you asked about smart contracts, I find smart contracts a far more efficient way to explain financial products. And what I mean by that is, let's take a house, and let's think about a token for a second. And a token seems to be very binary. So if I own a token and I give it to, can't read I need glasses. Eric's in front of me, perfect. So if I have a token that represents my house and I give it to Eric, you all saw me do that transaction, and now Eric owns my house. The truth is, though, financial transactions are far more complex than that. So let's take my house again. And I view financial assets as having rights, obligations, and benefits. And we can trade any part of those. That's what derivatives are. So in my house, I could have the right to live there, the obligation to mow the lawn because I live in a nice community, and I get the benefit of capital appreciation. Now, if I rent my house to Eric, as opposed to just give him a token, I'm renting the house. I'm giving him the right to live there, removing my right to live there, but he doesn't have the obligation to mow the lawn or the benefit of capital appreciation. So, and that in financial services could be described as a repo, where I own the asset, equity, I repo it to him, he doesn't own it, he has the right to certain economic benefits, but that's really it. And that's really why we like using things around smart contracts, particularly in financial services, so that, because it really does better define how complex financial capital markets works.
So I want to...
Yeah, go ahead.
So being the engineer, so I don't have to have a disclaimer here, but I look at this a little bit differently. And I am the co-founder of IX Ledger, which is on the blockchain. And we live in a world in which there's a lack of trust. There's a growing amount of data. Data is actually worth a lot. And if you look at like the 20 most valuable companies on that are publicly traded, a lot of them are based on data, right? So data is worth a lot. And you need data to actually have sort of a trusted, effective, low risk, speedy, compliant transaction, right? So do you think people are going to give you the data and say, here, let me put it behind my firewall like iTunes does? It's like, no way in hell, right? So this idea of using the blockchain, which is a really good data manager, and having all these frenemies that own little shards of data relative to, asset-backed lending, insurance, or whatever that might be. And you bring all those parties together and you give them smart contracts as sort of like a toll bridge. They control the rules by which that data gets accessed. They're in total control. That smart contract they develop, they test, they make that available all throughout that closed environment. But then you put an economic layer on it, because that economic layer ensures that party gets paid immediately, not 3 months, 6 months, 9 months later, but immediately, right? So you can take that economic layer, those tokens get used. You can use an exchange to actually convert to your fiat currency and pay for the assets. I often make a joke about OPEC as an ecosystem, and what would it be like if somebody, instead of using the dollar, decided to create an OPEC coin so that you could have total transparency in terms of where the money would go. You probably get shot and killed in an alley somewhere. But my point being is that the level of disruption that would occur would be huge. But if you can look at it from this environment where you want to speed up transactions, and everybody who's involved in that ecosystem, which may be more of a frenemy than peers, has total control over the transactions and the rules and the access to the data that they make available within that ecosystem. And that's a very different operating environment. And also, if you think about it, the way the money will flow is very different. OTC is all in dollars. OPEC is in dollars. A very large percentage of global trade is in dollars. So that's very disruptive, and it's kind of separate from thinking about the financial aspects, but it's about workflows and efficiencies and transparency. And I think that's where the real value is. So when you start looking at the value of these tokens, I think just the same way as JetBlue has a futures desk to figure out the price of oil, some of these organizations are going to have futures desks to figure out what these tokens are worth in order to be able to operate in these data environments.
So I'm going to wade into the deep end of the pool here a little bit, and I agree with everything you're all saying. Let me start, but I don't have a disclaimer, but Emmanuel sits on our board, and Josh chairs our largest working group, so I kind of feel like if I don't say the right thing, I'm going to get in trouble at the next board meeting. We often encounter that question: what is the difference between a digital currency and a token? And almost invariably, the question is, when they reference token, they mean an initial coin offering, broadly. And the simplest explanation that we discuss is we consider digital currencies to exist and have their existence because of a blockchain. Bitcoin exists, for want of a better phrase, as the unit of account for the Bitcoin blockchain. Ether exists because of the Ethereum blockchain. For the most part, tokens exist on top of blockchains. Tokens exist as app layers on top that build on top of blockchains for a variety of functions, and almost invariably, most of the token offerings that we're seeing, and you and I have spoken about token offerings probably far too much, are built on Ethereum, for example. And so that's the easiest thing that we offer our members around what is the difference, because it's part of that cutting through the noise. There's just so much of that cloudiness about the interoperability of these words and these names: digital currency, crypto asset, token offering. So that's how we approach that kind of delineation between the two.
Ron, can you then also talk to the difference between the utilitarianness of a token versus, say, the currency that's not a token, I guess, or maybe it is.
So this is what I get for commenting last. So not being a deep technologist, I'm going to go back to my previous definition briefly. We tend to look at something that is a digital currency as something that involves a medium of exchange and a unit of account for a particular blockchain implementation. You can build applications on top of a wide variety of different blockchains that have utility for a specific use case. And it can be, let's use the token offerings as a particular example. You can be creating a token offering to monetize houses, to tokenize the transfer of deed and title, to sell, tokenized bread, whatever it may be. And so again, I think there's a lot of overlap in this conversation about currency. It's a bit of a misnomer to call them currency broadly. I think they're really powerful mediums of exchange. But again, it goes to that delineation between the two. And utility value is a difficult conversation, because we're striking at the core of valuation for some of these offerings. And there's some really interesting work out there now. And Chris Berniski, for example, and Jack Tatar published a book called The Innovative Investor. There's several other, a bunch of other research around how do you calculate utility value? How do you calculate velocity of tokens being used across a particular network to derive value and to derive a price for a particular token? So that's how we look at that different perspective.
By the way, I don't know if everyone knows what a smart contract is, but maybe...
Is it smart?
Not really. No, it's not very smart. But maybe can just briefly touch on that and then talk about how there's an interplay with the token sales. So this is a very non-technical description, don't worry. If you think of an example that frequently is given is a vending machine. All right, if you put money into the vending machine and you push the button, assuming that the vending machine is working properly, you'll get your bag of chips as soon as you put in your money and push the button. You don't need a human to take the money and give you the chips and make sure it happened. It happens automatically with if-then logic. A little bit different because you get to push a button, but the idea with the smart contracts is non-technical way of describing it is it overlays the blockchain and it uses if-then logic to cause something to happen upon the happening of something else. So sometimes there are also things called data oracles where if you have to pull information into the smart contract that is available in the real world, like what is the price of gold today or something like that, what is the price of a share of stock, and if that would cause something to happen in your contract, you could pull that in. But the way this is often used, or the way it is used, frankly, in many token sales, is that's how you get the money in for the token sale. So someone will pay for it using a smart contract. So you may give some of your Ether or some of your Bitcoin to purchase these altcoins in a token sale. And just stepping back, someone earlier had mentioned the DAO and how 50 million of virtual currency was taken from it, right? It was because of a smart contract vulnerability. It was because of a vulnerability in the code. So,
Jeff, do you want to add to that?
Yeah, no, I think it's helpful. So, I think folks are hearing some of the terminology in this space, and it can be a little bit confusing. Sometimes you need to hear it a few times, but just to kind of maybe clarify some of the specific terminology that's used, because often this terminology is an analogy, and we have to remember that the analogy doesn't mean it's the thing it's an analogy to. So let's start with the term cryptocurrency. We describe them as cryptocurrencies, Bitcoin, Ether. There's a number of these that are described as having properties that are similar to currencies we're familiar with, like, the dollar, the pound sterling, Swiss franc. But these are not, at least in the United States, these are not legally currencies. The definition of a currency, as defined by the IRS, as defined by the Treasury, that the CFTC relied on when we made the determination that Bitcoin could be a commodity. A currency is something in the United States, the legal definition, it has to be issued by a sovereign entity. It can be the US, it can be Switzerland, it can be the UK, it can be Europe. So cryptocurrencies are not currencies in the US. They are not legal tender for payment of debts. So we refer to them as cryptocurrencies, but they're not currencies. Now, looking around the world, there are some countries that actually have passed legal determinations that you can use Bitcoin or certain other cryptocurrencies to perform as legal tender to discharge debts. But generally speaking, in the US, cryptocurrencies are not currencies. To give one other example, we talk about exchanges for cryptocurrencies or for these digital tokens. These are places where you can go where people, open up accounts and they can buy or sell them. And you think it's like a brokerage account, that you're operating like you're trading stocks or bonds or something that's traded. But the things that people call exchanges are not exchanges in the eyes of regulators. In the eyes of the CFTC or the SEC, an exchange is regulated, has a legal status as a regulated trading market. It has a rule book. It performs market surveillance against fraud and manipulation. It has a self-regulatory authority to sanction people who transgress those requirements. Now, some of the, quote, exchanges in the U.S. Do have a regulatory status because they're regulated under state money transmitter laws, so which generally the requirements have to do with protection of retail customers and anti-money laundering and know your customer requirements. But people will say, oh, I went and traded this on an exchange, and they think they have the same protections that they would have if they went and traded it on the CME or the New York Stock Exchange. But that's not actually the case. It's an analogy, and we need to remember as we look in this space that analogies are not the same thing as the thing you're making the analogy to.
Okay, and I'm glad you brought up the exchanges because I want to talk a little bit about buying a cryptocurrency on these exchanges. We have some people over here who've done it already and nobody over here except for maybe one or two people. I know I did it for the first time. Over the holiday, I decided I was going to jump in, buy some cryptocurrency. So I decided, well, what exchange am I going to go on? I decided to open up an account on Gemini, which took about, 3 or 4 days. They had to validate who I was. Then I decided, okay, I want to buy Ethereum. So I had to get money into the account. It's all very clunky, okay? Then you have to get the money in the account. Then that takes a few days. And as you're watching this, the price is going up and down and you're missing the rally and you're going, oh my God, this is awful. Finally, the money's in the account, 8 days later, and you're able to buy something. And you buy, so I'll buy the Ethereum. But, I want to buy some Ripple also because everybody's talking about Ripple. So I want to buy, so how do I do that? Oh, I have to have an account on Binance. What's Binance? I have to get the Ethereum over to Binance and then use the Ethereum to buy the Ripple. Okay, this is what it's like. It's very confusing, but I figured it out and I did that after Ripple got up to $3. Whatever, I'm just going to put $500 and let me test this out. I think in total I invested about $3,000 and I still own everything and everything's back down to where I originally bought it after I made a lot of money. That's back down. But, and I'm just holding on to it. I just today received this in the mail, which I bought from Amazon. This is my nano ledger. Okay, so now I'm going to take my coins off of the exchange and put them on the nano ledger and then put this in my safe deposit box. That's what it's like to trade cryptocurrencies right now. So I just want to open that up for discussion.
That's a great story.
Well, hopefully it wasn't tampered with.
I'm
Make
just
sure
impressed
that the nano drive wasn't tampered with.
Yes,
that's another
good point.
I'm just impressed you tried to time trading in some of these markets.
Well, I thought I could, and then I quickly learned I couldn't. I didn't know. It was a learning. It was an experiment. So now I know.
Great perseverance.
Mm.
So does anybody want to talk? Let's talk about maybe valuation or liquidity. This is obviously an issue. Institutions cannot invest in instruments that have no liquidity like this in a big major way. And I think, I've heard of some exchanges that are being developed right now to address this or solve this problem. Does anybody have any insight into this or what the answer is?
I got to be careful now.
Yeah.
So banks have many exchange platforms already. Credit Suisse has a couple of great dark pools that could easily accommodate. Banks are familiar with building exchanges, regulated exchange products, and creating exchange to accommodate cryptocurrencies is not really that difficult. It's not challenging. It's just a different ticker. I think the challenge for banks is really the uncertainty around the legal framework, the regulatory framework, and that's why I think many banks will give pause before jumping in. I think the CME, CBOE allow some institutional. The other question you asked is about liquidity, and liquidity is institutional investors getting involved in size is really about finding liquidity, and I think to Jeff's point, not all exchanges are the same. So, and you'll find massive discrepancies or differences across different exchanges, and that's where some of the arbitrage is, right? One of the greatest trades that ran for about 3 years was BTC to USD back to Rubundi and then back again. You just keep looping that every 7 days. You can make 10,000% returns. And that's what people were doing for about 3 years. So liquidity is, and in fact, when was it when Zimbabwe had their issue? for like 3 weeks, we found Zim dollar to BTC, whilst the rest of Bitcoin was trading at around about 6,500, 7,000. Zim to BTC was trading an equivalent dollars 13,000. So people trade that if you can, you trade the inefficiency of the different equity pools or different exchanges.
It is an access problem, though.
Yeah.
Right. I mean, you have that arb opportunity in South Korea, but at an institutional level, you don't have the access to turn around those trades as quickly and as well.
Right.
We have the opportunity, and we part of the WSBA conversation is with institutions globally. And while there's deep institutional interest, the tool set and framework to allow them to engage still isn't there yet. I mean, at a retail level, one of the larger exchanges, Kraken, was down for 27 hours the other day. Coinbase has 13 million accounts. And yet sometimes, given a high volatility, there are backlogged hours on executions. Tell a hedge fund they're not going to get an execution. Find out what happens. And so this institutional conversation around liquidity, price discovery, the tools to do it, it's coming, but it's not there yet.
Yeah, I think the assumption that everyone's, I think, again, Jeff mentioned that you think that you're getting, how do you know you're getting best price execution, which is a requirement in the US for exchanges that you're trading on, but it's not a requirement because they're in a different legal structure. So you may not be getting best price execution. In fact, on some exchanges, you certainly aren't. So, yeah.
Well, it's interesting because, I mean, security is a big issue. I have so many friends who said to me, oh, I wish I'd gotten into Bitcoin whenever, last year, 2 years ago. And I always say to them, well, be thankful that you didn't, because I'm sure with all the viruses that get spread so easily, you would be gone in a nanosecond. So, I mean, I'm sure you heard about the Showtime incident where there was this Trojan who was stealing keys off people's machines. And so I think that the security aspect cannot be underestimated. I mean, any of those who have participated in these token offerings, as I have, you're constantly getting hack attempts. I've gotten my SIM card on my phone taken. I mean, I have gotten hacked nonstop. And so I recognize that, if something as simple as one of those little nano devices can be very helpful, but you really need to have a strategy to hold on to that money. And it's not that easy. So.
And you bring that to the custody conversation now, right? At an institutional level.
Yeah.
Who offers custody that would be suitable for that marketplace? That's only starting.
So if it's okay, I'd like to just touch on one thing relating to liquidity and sort of the tensions that are out there right now and some possible future things that may happen. So a lot of people focus on the guidance from last summer from the SEC, where they said that the DAO token was a security. The DAO, for those who don't know, was a virtual venture fund, and it did a token sale. What they also said, though, was that not only was the DAO token a security, but the platform, the actual token sale platform that was used to trade the DAO token, was a securities exchange and needed to register as a national securities exchange or avail itself of an exemption from registration, such as by becoming an alternative trading system, or ATS. So what does that mean? Well, for all the exchanges around the world, right, they have a few choices. If they are serving U.S. persons, then they have a critical task if they don't want to register as an ATS or as a national securities exchange, in that they need to make sure that no tokens that are securities end up on their platform. That's why for a lot of the cryptocurrencies exchanges that U.S. persons can access, there's a very small amount that you can choose from in terms of tokens. Or they could, for example, exclude non-U.S. persons. So this leads to an interesting tension, because if you're a token seller, you're going to want, assuming that you may want to have a secondary market and have liquidity for your token right now, there aren't a whole lot of ATSs out there. There isn't a way to have a token that is a security at the moment have a lot of liquidity. So people are straining, or they have been straining, to say, I have a token that is not a security, and going through all these machinations, and some likely are not securities. However, the window and the needles, the hole in the needle is getting slimmer in terms of how you thread it and how you can say this is not a security. My personal view is that in the next year, we will see a growing number of self-identified security tokens. We already have seen the announcement with Codacoin recently, for example, which is being sold under Reg S and Reg D. So accredited investors in the U.S. and then certain persons from the U.S., the U.K., Canada, and I think they said certain other jurisdictions. I think we'll also see some under Reg A+, and potentially some that are full-blown registered securities. We'll also see some utility tokens, I'm sure, but I think we will see a large number of ATSs springing up to provide liquidity. And in fact, I guess towards the end of last year, Rengen, T0, and the Argon Group had announced a joint venture to have an ATS. So I think that's what I think about liquidity.
So going back to your situation where you have to jump through all these hoops to, well, you can put dollar into crypto here, but then you need to go somewhere else where you can only do one crypto into another token. These kinds of frictions and operational complexities, it's part of the growing pains of the fact that we're still at the early stages of this market. Mm-hmm. And probably the frame of reference for most people in this room, and then, for me as I started to get into the space, is I'm used to how other markets work and a lot of the operational convenience and safety and resilience. If I sell something, the funds are available, immediately, not 8 days later. I don't have that uncertain. There have been times, as Emmanuel and Ron were alluding to, where I logged on to Coinbase to try to sell some Bitcoin. I couldn't get in for a day and a half. Then I was like, okay, well, maybe I'm fated not to sell it. Let me see how it does. A behavioral psychologist is just studying, the fear of missing out. People who, there are, I've friends who got in, early and have a bunch of it. And I'm like, well, isn't this great? Aren't you going to take something off the table? And they say things like, well, I'm not going to sell anything until selling it would change my life. I'm like, well, how much have you made already? And, there's already 6 zeros after it, but they want 7 or 8 zeros after it before. So this is the psychology of, people who are, and, I'm slightly skeptical, but I'm generally, positive and bullish about the space, not investment advice. But, I still think we are at the early phase of, a new type of, digitalization of assets where, it's exciting and powerful, but also scary. The fact that, I can transmit an asset without going through an intermediary to you, or you can send it to me, that's very powerful. And that has not previously existed in the history of people. It's a very powerful thing, but it's also very vulnerable. The fact that we can send it to one another very easily makes it very easy to hack and steal, and that's why you need to have these devices and backup things, and then people have to figure out where they're going to write down all these words, because it's putting these things, it's giving individuals power, but that power is kind of very difficult, and it's full of risks, and people opt for convenience. But will people continue to do that? I think we're at the early stage, and I think these questions are going to be answered. If you look at 2018, we will have greater legal certainty over a lot of these things at the end of the year than we have right now. I think some of these operational challenges we will have made progress on, but I think there will still be plenty of unanswered questions. We could be together here a year from now and there will be progress, but I think it's still a work in progress.
Before we get to questions, and because we could talk about these issues all day long, there's another part of the conversation that I want to bring to the audience, because it's a little more esoteric and nobody's addressed it yet. And this is the question about, what does this talk about taking energy to produce cryptocurrency? What does that mean? Why does it take any energy, and how are people trading this energy to make the cryptocurrency? Does anybody have an opinion or knowledge of this?
Yeah, somebody said that 60% of the electricity in Ireland is being used for Bitcoin, which is kind of shocking. But I do see some innovation coming down the pike that may actually change the efficiency. But Bitcoin actually is the sort of grandfather of all of this innovation. And there are many, many different protocols that have come as a result of that. If you listen to some of the talks about the sort of new fork that they had in November for Ethereum, it talks a bit about moving to a proof of stake in order to conserve energy. And there's a number of other protocols that are underway to more efficiently mine without having to use so much energy. But I think that Bitcoin actually was the grandfather to all this innovation, and it will have some staying power. But yeah, it does take up a lot of energy.
Anybody else want to respond?
I think it's spot on. I think ultimately there's another play, right? You invest in tech companies were investing in ASIC cards when Bitcoin was the new kid on the block, as we use the grandfather analogy. And as I think we move to things like proof of stake, GPUs will take over. So there's another, if you want to think about an investment opportunity, think about GPU production versus ASIC production. But I do think that there are other consensus protocols out there that will show themselves to be more efficient, kind of the planet, and just as effective. So I think we're in the early days of like consensus protocols that work for public networks.
Yeah, I think those are great explanations, but I think it's worth taking a step back. Just say why is this activity necessary at all, and does that apply to all blockchains? So blockchain is, I think there have been kind of at least three major innovations. There's kind of these efficient digital currencies that can operate in a decentralized way. There's the idea of a distributed ledger or blockchain, and then there's these kind of tokenized asset offerings. So when it comes to blockchain, the mechanism that's used in Bitcoin to validate transactions is that you have all these miners who are competing, and there's an arms race of rapid computing power that does consume energy to prove these things. But blockchain can also be used for other types of applications and is being used by banks, by exchanges, by insurance companies, by all sorts of, it's being used in healthcare and in music and other intellectual property. So blockchains are being used, and even though the original kind of Bitcoin blockchain is this decentralized public blockchain that anybody can access, there's no central authority who grants permission. Blockchain technology is being used in lots of places. It's being tested to give identity to refugees, and in many of these other applications of blockchain, which are not the Bitcoin blockchain, you don't have this massive energy consumption to use it. So blockchain technology, sometimes called distributed ledger technology, is being used in all sorts of innovation around the world. And this whole energy consumption issue is not even relevant because they're private or they're centrally operated. There's a central authority, and that sort of eliminates the requirement for this. Now, the reason that in Bitcoin blockchain you need this was that Bitcoin was invented, and this is part of the genius of Bitcoin, to solve a very specific problem, which is that, if you have a digital asset that we can send to one another, how do we solve the double spending problem? I could just copy and paste it and send it to everybody in this room, and how do you know I haven't just sent the same Bitcoin that I sent to you to 200 other people who are sitting here? So, and what Bitcoin was also trying to solve was, instead of having a centralized network like the central bank and sovereign governments that at the time of financial crisis were so mistrusted by the inventors of Bitcoin, how do you have a decentralized network that anybody can access where there's no restrictions on permission, and how do we still prevent double spending? And how do we prevent creation of these fraudulent Bitcoins? And so that's what this whole proof of work consensus mechanism was designed to solve, that in a decentralized mechanism where anybody can access the network, including bad and malicious actors, there's a mechanism to validate the transactions that can make it safe for the entire network to use.
So I just wanted to add to that, because talking about the private networks, which are actually used a lot to facilitate frenemies trying to share data, you may not even have more than 12 nodes, and they're private. And so you don't have this energy consumption issue there. So Hyperledger, which actually is used by IBM and R3 and a number of other companies, is really just a workflow blockchain. And they've argued you can put an economic layer, but they don't have any coins or economic layer. It's all about workflow and trust and visibility and compliance. So when you hear blockchain, not all of it has a coin associated with it. And there's hundreds of versions of private blockchains out there.
Last point on, because I want to make sure you all walk out with this, because you use the word blockchain and DLT ubiquitously, and they're actually, it's probably worth explaining what the difference is. But also, the word my colleagues in the panel are describing is consensus, and machine proof of work, proof of stake are just forms of consensus. Private blockchains don't need to use those forms of consensus. Most of the things that we work on uses something called BFT, Byzantine fault tolerant. You can have various implementations of Byzantine fault tolerant. It's a protocol. And an example of it would be, let's say there are 200 people in this room, and we all are on a blockchain together. We all know each other. We're all friends. And I say, the next transaction is going to be the hash of 2 + 2. And I randomly pick somebody that nobody knows I'm going to pick. I'm going to pick that Jeffrey. Jeffrey's going to tell us what the answer is. Wonderful. We all agreed it was 4. We all worked out it was 4, and we add it. And then we do exactly the same thing with another transaction. It's 3 + 3. I'm going to go to Eric, because I can see his name. And Eric says, I'm going to ask Eric. Eric says it's 5. And 299 people in the room knew the answer was 6. We're all running the same software. Something must have been up with Eric. So we vote him off our island. We replay the transaction. We get 6. Mm-hmm. And he can't rejoin our network until we figured out what went wrong. Right, because that's how in a private network we can do that. The reason why that protocol, BFT, doesn't work in an unpermissioned way is because if I'm a bad actor, all I've got to do is fire up 2/3. I'm going to fire up 500 additional machines behind us, make them up, and now I'm going to, because I can't predict which one of us was going to be the next person to be picked to add the next transaction. And so that's why in a private world, that works really well, provided we can keep the borders closed. And it's very efficient. It's not as efficient as an exchange. It can never be, because we're all keeping asking ourselves, did you get 4? Did you get 6? Those confirmations take time. But it's actually, from a settlement perspective, incredibly efficient, and is a game changer for what we're trying to do within financial services.
And I was just going to say something very, very quickly, which is just to keep it into perspective. And I don't have the figures in front of me, but a friend of mine had done some sort of comparison of the cost of mining gold, right, versus the cost of mining Bitcoin. So, gold is expensive too in terms of energy costs.
That's true.
Okay, I think that's was that your entire point? Did I cut you off?
Mm-hmm.
Okay,
no.
I'm gonna open it up to questions now, because I know we have some questions. To the gentleman down there.
Okay, I have a question about proof of work. Like, not all of cryptocurrencies are actually computationally intensive, right? So you have newer Ryblocks and IOTA, which allows you to basically send really cheap transactions. What are your thoughts on that as being the future of cryptocurrencies? Maybe Emmanuel, you can answer.
So the question was, you're comparing proof of work to what? Sorry, keep the mic. Just go.
To feeless cryptocurrencies like Ryblocks and also IOTA, in which the node operators, it allows banks and different corporations to send really cheap transactions. So say if you want to send 1 cent to someone or even 5 cents, you can send free transactions practically, right?
You can send free transactions in Bitcoin. I don't really have a strong view on the different consensus algorithms, particularly in the public blockchain space, unfortunately. I don't really focus on it so much. What I focus on is blockchain and the relative business benefits. And as a result of that, it's really focusing on things like modified BFT, Paxos, those types of protocols. Sorry, I don't have a great answer.
I think it all depends on what you're trying to do, because I don't think of blockchain as just being about moving money. I think about it in this world where data is worth so much. in which you need data. I mean, think about it. If you're going to insure someone or you're going to finance something, you need a lot of data from a lot of different players, and people are just not going to give you the data for free. So this whole idea of having frenemies on a network where they each have control requires one type of network. I go to a lot of blockchain events, and I always hear this example of voting, right? And I sit there and I think, what is everybody going to pay to vote? Because if it's a public blockchain with mining, you're going to have to pay to vote. You can't just, and then if you go to some third world country where you only have 2 servers, you can't really offer, a secure way. So it's not one protocol for everything. It kind of all depends on what you're going to do and what the requirements are, how much you trust the entities that are part of the ecosystem. Is it closed? Is it open? So I don't think it's a one size fits all.
Okay, so what I would say is that Bitcoin is more like digital gold, right? Only 1% of all transactions are actually payment for goods and services, but the altcoins, it's more like digital silver. So silver, there's actually industrial uses, right? Mm-hmm. So probably about 40% of the demand is from industrial uses. So the altcoins is all about the utility value, right? Like with Ripple, cheap international payments and whatnot, right? So, thank you.
Okay, Eric?
Thank you. You just touched a little bit on proof of work as it relates to private networks, but I was hoping one or more of you could elaborate on, in layman's terms, the mechanisms of how public transactions are unlocked through the mining. That's something that's
of how proof of how mining works. I can do it, but I can do it. It normally takes about 20 minutes. All right, so there's a couple of ingredients. Let's try this out.
Go.
In layman's terms, right? So you know what a hash is? A hash? Anyone? People know what hashes are, right? I know this side know because they've been on mining for years. This side don't know, do they? No. So there's a couple of ingredients that you have to know about. These are actually really old in terms of mathematical proofs. You've got to look up Merkle trees. Ralph Merkle wrote the paper in 1976, I think it was, mid to early 70s. And you've got to know about hashes. Hashes are one-way mathematical functions. First one was called MD3 or something like that. Bitcoin uses a hash called char256. What a hash is a one-way mathematical cryptographic function, which means I put an input in, I get an output out, and the output is always guaranteed to be the same if I put the same input in. If I take the complete works of Shakespeare, and why wouldn't I? Because I'm a Brit. I take the complete works of Shakespeare, I put it through char256, I'm going to get an output of 256 alphanumerics that will always be the same, unless if I change one comma, add a space, the whole output changes such that I couldn't tell what was changed from the input. So there's 2 really key characteristics of this particular function, char256, that I need to have. One is it's called deterministic. That determinism was really, I take an input, I get the same output. And the second thing is it has to be collision resistant. Because what I've just described, I can take an infinite number of inputs and I have a finite number of outputs. The finite number is 256 factorial, okay, which is a big number, but it's still a finite number. So collision resistant means, is there a chance that 2 inputs can have the same output? And the answer is yes. But you have to have a degree of confidence that the chance of that happen, that collision is going to be rare. Understanding and rare in this context means an extinction level event happening in the next 30 seconds. We all feel comfortable that that's not going to happen in 30 seconds. So we feel pretty good about it. So we take that ingredient, this char256, and we form a transaction through it. And then for the mining process to work, what we say is, well, producing a hashes, by the way, are at least 30 years old. They were born of hardware, RAM compute, moving when we first had to move information out of the RAM memory, random access memory, into ROM memory, read-only memory on a hard disk. That process was using hashes. Anyway, digression. I said, how long have I been so far?
You got 9 minutes. Go.
I'm trying. I'm speaking quick. It's very. It's. You need at least 5 different mathematical kind of to get it all. But I'm going to try you with 3 of them, and we'll see where we end up. So you take. So what's this proof of work thing all about? Well, producing hashes is actually not that hard anymore. It's not that challenging with today's compute. So what we ask you to do is we ask you to compute a hash where the first leading positions in this hash in 256 are 0. Made it a bit harder for you now, because remember it's one way. So if it's a one-way function, if I've got a static input, which is the transaction that you want to verify, let's say it's one transaction, and that one transaction, if I play it through, we've already determined is deterministic, it's going to produce the same output each time. But I want something which has that transaction with 8 leading zeros. Well, to do that, I've got to add something to it, and I add a random number. It's called a nonce. I add a random number to it, and I got to keep changing that random number as many times as I can until one combination of this transaction plus a random number generates something with 8 leading zeros. Soon as I get it, I shout it out to the audience that I got the answer. And it's very easy to go from the answer to the input than the other way around. So we call that brute force, calculating, guessing. It's like me saying to the room, hey, everyone, can you tell me what the calculation of the square root of 125 is? I pause for a second because some of you tried it. This is called System 1, System 2 thinking in the brain. The human brain is the laziest organ in the body. So some of you tried it and you thought, it's 11, it's 12, no, I give up. That's what your brain did. But if I tell you that it's 11.17, some of you might actually, if you're good mathematicians, work it out. That will work out to about 124.997 decimal places. All right, so it's easier to go one way than the other, and that's to a computer, that's the same thing. So if I give you the hash, you can really calculate the answer quickly. So what happens in this proof of work, roughly speaking, taking a block of transactions, putting them in a hash, then trying to guess the hash of that block that produces the leading 8 zeros should take a very, very fast computer, an ASIC card. It's been specially designed just to calculate that bit of math about 10 minutes. And in spending that 10 minutes, you're burning energy. You're basically creating a nice warm room for yourself because your machine's working really hard. And on average, it's about 10 minutes. And what the protocol does is it self-adjusts every 600 minutes, about 2 weeks. It self-adjusts. If it finds that computes on that it solved the problem on average quicker than 10 minutes, it will increase the difficulty. It means it asks everyone to solve it with 9 leading zeros to make it harder, and so forth. So in other words, if the power of the computing that people are applying to it becomes more and more powerful, then it self-adjusts. And in that process, it's making people spend energy in order to solve the problem is one of the underpinning of why proof of work is all about. And the theory behind it is because, and this is the last piece of the puzzle, I promise, the theory behind it is that if your chances of winning a single CPU, of being the first to guess the prize, is about once every year and a half. So what do we do when we play the lottery and we want to increase our odds? We buy more lines, we buy more rows, spend more money, or we join office pools. And that's really what the same thing is true for Bitcoin. So you either buy more server space with more servers to calculate it. And by the way, a mining rig is like 256 of these processors in a row and 10 deep. So one machine already has a lot of processors. Then you join a pool, which basically makes the chances even in that, your chance to win in once every year and a half. So don't go home tonight and download the software with your little machine and expect to win anytime soon.
I just want to add
it's
one
that
point.
Simple, folks.
Yeah.
Sorry, that was about 5 minutes. Sorry.
Good job. I just want to add one point is that the value of your brand new hardware is only valuable for a couple of months, and then you're going to have to cycle it out because you don't get any more Bitcoin. So which is one of the reasons why it's hard to. People always comment on how many rigs there are in China but you're not going to maintain the lead for a very long period of time unless you're cycling out your machines very quickly.
I tried it when I first got into Bitcoin, and I took an old machine, an old Mac, and I put it under my stairs. And sadly, I didn't win anything. My machine didn't win, and it wasn't when he did the math. It wasn't surprising. And what people nowadays, you can actually rent server space. You don't have to go and buy it yourself. You can actually lease it for a month if you want. So there's lots of applications out there for doing that. So yeah, don't literally go home and do it. You can go online, I forget the services. You can buy you can rent 1,000 mining rigs, lease them for a month, and see how you do.
I think we have time for one more question.
Yeah, actually, there's a question online here. What does the panel say about the recent state cease and desist letters? I don't know
that's. I think there's going to be more of those. I think the most recent one was in Texas. BitConnect. What was does anyone recall the name of the one in Texas? Yeah, look, the regulators are paying close attention to these kinds of things. They're being proactive. They're not waiting till after the fact. And, I think the market is on is on notice. Josh talked about kind of some of the very clear guidance the SEC put out last year about the factors that get looked at about which one of these are or are not securities offerings. So federal regulators are looking at these. State regulators are looking at these things as well. There are state securities laws too. So I think that we can expect, more of that. There will continue to be enforcement action. But having said that, the fact that there will continue to be enforcement action, this is a novel mechanism of, capital formation. Securities regulators have kind of two basic sets of responsibilities. One is investor protection. The other is capital formation. They balance both of them. But, I think that we will also continue to see more and more legitimate offerings, availing themselves of securities laws or exceptions, known, well-charted exemptions to securities laws. I think we will continue to see those. So we'll see both plenty of enforcement action and plenty of legitimate offerings.
Sorry, one more question.
Yeah, I just, for those of us that are outsiders to the space, can you talk a little bit more maybe about the sort of exchanges, aren't exchanges, and your confidence? For instance, Christine, you've been hacked many different times, it sounds like. When you go to a Coinbase, what confidence should we have that there is a lot of, technology development behind that to protect denial of service, things like that, that the infrastructure is actually being built, that the right programmers are there? I feel like you look at these websites, they look slick, there's limited information, and you don't know whether they employ, 5 people or 500 people.
So I want to clarify, attempted hacks, not total hacks. But I think once again, the cold storage is something that not all people actually adhere to. So
this is the cold storage.
Yeah, the cold storage. When you're storing stuff on exchanges, it's inevitably like a honeypot. And so I think that's can be problematic. And I don't know how diligent most people are when they're utilizing these services. I think when the Bitcoin futures were announced, was it 100,000 accounts were opened on Coinbase? So I have no insight on how they're managing that process. So it's hard to say.
Yeah, I mean, just to at least try to attempt that. I'm not trying to disparage, Coinbase, Crackjack, and any of those, but I would say that, a regulated exchange that's regulated by the CFTC, exchange or clearinghouse, there's a whole set of, in terms of kind of operational and technological safeguards and resiliency. There's a statute, then there's regulations. Then the agency has a team of examiners that goes in and every year that looks to see whether they meet those criteria. The exchanges are also required to have kind of self-policing mechanisms that are written there in law and regulation, and they're required to have a certain amount of expertise in order to do those things. Can there still be glitches? Are there trading outages even at regulated exchanges? Yes, there are, but many of those things have been mitigated over time. Now with these other platforms, and I think of them as trading platforms. The SEC used the term trading platforms to describe them in the Dow report that Josh referred to. They're not exchanges. I think that they are, to my understanding, they are voluntarily trying to hold themselves up to good practices. They, there's a degree of disclosure about what those practices are. I believe they're, in good faith. Some of the ones we've talked about are trying to meet those standards, but that level of, transparency of third-party scrutiny by an experienced independent regulator, is not part of the landscape today in the U.S. In some other countries, they're starting to have that. For example, in Japan, they enacted a new legislation last April that went into effect in October to create direct regulation of the cryptocurrency trading platforms by the Japan Financial Services Agency. We may start to see more of that in other jurisdictions. I'm actually a believer that investors trust regulated markets, and the presence of regulation gives investors greater confidence that, that there is the proper oversight. So those exchanges that we're talking about are trading platforms. They may have some of those attributes, but it's hard to know, and there's not a regulator like the SEC or CFTC looking over their shoulder, making sure it's in place.
Yeah,
sorry. No. I just wanted to add that hacking in general, you think about Equifax. I worked for a financial trading platform, I won't say any names, where somebody in the company, they did one of those phishing emails, and they sent everybody's W-2s out to a hacker, and everybody had fake tax returns filed. This is a financial firm. So while I believe that all the regulatory efforts are great, it doesn't really help when you've been through something like that. So, and that had nothing to do with being in the crypto space. So I just think that hacking in general is happening all the time, and social security numbers are on the dark web for nothing. So, and many firms like AT&T and bank accounts with 4 digits or part of your social security number, you can open things wide open, take over somebody's SIM card. So I feel like, the hacking overall isn't just in the crypto space. It's just that if you steal it in the crypto space, sometimes you can get away with taking it and putting somewhere that people won't track.
Yeah, I guess to that I would add, we are seeing, at least with exchanges that I've spoken with, we are seeing that they are trying to comply. And certainly we've seen in the media that say like the Gibraltar Stock Exchange is going to be developing a blockchain-based exchange. So I think we will see more compliance and more transparency. But I think at this stage, just as I think people need to be very careful. So we can't provide, some kind of recommendation that, yes, you can trust these things. I mean, they're hard to get to. They're hard to access. That's because it's developing. Just like with the various digital tokens, there may be tremendous concentration of holdings, and all of this is new. So I think generally, to the extent that someone has a great risk tolerance, and wants to embark on this journey, then that's great. And to the extent that others have less of a risk tolerance, then perhaps that's something that people do not yet enter.
Yeah, and I just want to add one last thing, which is you can still invest in just regular, stocks that are trading on the New York Stock Exchange or the NASDAQ, like IBM, which is very boring, but they are definitely one of the leaders in the technology that's backing all of this. And it's a sleeper, but they are the leader in it. NVIDIA, Overstock.com, and Amazon, I guarantee Bezos will come out with a token. That will happen. I think that he's already bought up certain URLs like Amazon, Cryptocurrency.com, Amazon. There are a number of these URLs. So you don't necessarily have to go and buy Bitcoin or Ethereum or XRP to be involved in this market. And with that, I guess we'll move on to the next part of the program. Thank you so much to the panelists. You're wonderful.